Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn with Focus Compounding, on air live with Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you're tuning in with us, thank you so much for joining us. Be sure to check out all of our content that we push out into the investing universe. The best way to do that is to follow me on X at Focused Compound. If you were watching on the screen right now, this is FocusCompounding.com. If you want to get access to investment write-ups from Geoff going all the way back to 2005, you can click that blog section to get our archive. Um, so much information. You could type in a topic on your mind in the search bar right here, click find, and you will find a bunch of different write-ups that Geoff had wrote through the years, and basically be able to get his thoughts on that topic. I guarantee it. Whatever you are interested in investing wise, especially if it has a value investing bent, you could type it in and you will find something related to that topic at our website, focuscompounding.com. Be sure to hit the subscribe button too, wherever you are listening or watching us here today, so you will be updated every time we upload a podcast. So, in today's podcast, Geoff, I want to talk about how to spot a business that Warren Buffett would like, and really talk about through the years how Buffett's investing has changed, um, uh, tailor it to perhaps the individuals that aren't investing. What do you think, Geoff? You think there's some individuals listening that have over $100 billion to invest?
Yeah,
Think it's
probably
you
not.
think it's probably likely not. So maybe we could, talk through different stages of Buffett's investing and relay it back to the individual. But stick with this Buffett theme as we come up to the annual meeting, which of course we will be at. So if you
Mhm.
are going to be in Omaha the week before, I mean, the meeting's May 3rd, which is on a Saturday. If you're going to be there leading up to it that week, and you are a interested investor, like to talk about stocks, reach out to me at andrew@focuscompounding.com. We'll see if we could set something up on the schedule. So email me, andrew@focuscompounding.com, if you are going to be at Omaha. So, anyways, yeah, let's just talk through how Buffett, how he thinks about things. I think now more than ever, Geoff, it's a great time to be talking about these sort of stuff. I don't think this is like the .com era where he's at the conference and he's being laughed at by all the tech wives and all
Mhm.
everybody. Oh, this crazy old man from Omaha, he's off his rocker, right? Basically my entire life he's been known as the old man, but he just keeps living, so whatever. Right. 29. So but yeah, let's talk about that. So, just generally, why don't you talk through Buffett's investing style and how it's really changed through the years? And just because Buffett invests a certain way today does not mean that that's the way that everyone listening should invest. There's one Substack I do want to shout out. What is it? Is it Dirt? I say I should probably know the name if I'm gonna, shout him out. Is it Dirt Value
Dirt
Stocks? Dirt Cheap?
dirt
What
cheap
is that?
stocks?
Yeah, yeah.
I
He's
think
a,
so.
a
Dirt cheap stocks is a Substack, I know.
yeah. Let's see. Yep, there we go. Dirt Cheap Stocks. So great place. Like I think the stuff that he talks about, it's like Buffett 1.0 type of stuff
Okay.
that he focused on. He gives these little tidbits here that link to his Substack. So yeah, why don't we just start from Buffett 1.0 and go through how it's changed, and we'll just go from there.
So there's this book, Buffett's Early Investments, and that Brett Gardner is the author, and it was published in the last year. And that one has, let's see, Marshall Wells, Grief Brothers, Cleveland Worsted Mills, Union Street Railway, Philadelphia and Reading, that's a big one, British Columbia Power, American Express, Studebaker, Hot Child Cone, and Walt Disney Productions. So several of those are not um, uh, like net type stuff. American Express, 1964 is obviously a high quality business. Walt Disney Productions, 1966 is high quality business. I mean, the most high quality in the entertainment industry, although at the time it was the cheapest, probably. Um, Hochschild Cone and Studebaker are third rate in their industry. British Columbia Power's an arbitrage. Um, some of them still exist to today, right? So the Cooperage Company that's still around in just different containers now, 70 some years later. And then Union Street Railway, that's covered in the snowball a little bit. Philadelphia and Reading is probably the most important one because that gave him the idea for Berkshire Hathaway to turn it into a holding company, and everything. Because Philadelphia and Reading is a Graham Newman controlled company. They didn't own a lot of it, but they controlled it effectively. And they did a lot of things to change how the capital was allocated over time. So it's a mix, even from the early years, of having an importance of business quality. But the really important thing is a low enough cost, too. All of those are pretty cheap. I mean, an interesting thing to say today is, can you invest like Warren Buffett? He's not buying anything. So we can see his filings. He is buying the Japanese the Japanese trading
Yeah,
companies. Sorry,
trading houses. Yeah, I
yeah.
saw it the other day.
Which he and said in the annual letter that he would buy more of them. Everything else except Occidental is probably not a purchase by him. I mean, he could be buying VeriSign or Sirius, but those are less likely. I think those are much more likely not him. Constellation Brands, unless it's going to be some huge purchase over time, that's not him. Pool Corporation, I don't see that being him at all. And Domino's, but I also don't see that as likely being him. So they're either very, very small changes or he didn't do them. So, and he has been selling Bank of America still, and he was selling Apple. So he's buying a small amount when it gets under a certain price of Occidental, and that's it right now. So for the last, and he's buying the Japanese trading companies. That's definitely true. That's a big investment. So today he would be doing nothing, because we know that he is doing nothing. Um, so that's the difficulty for people. I mean, how do you do that if you're managing money or something? How do you do that today? I don't know. He left the game once before, and I guess he would have had to do the same thing in the 1990s or today. Um, that's why Berkshire is a vehicle that he could use continuously and stay in the game all the time, instead of if he was managing money or something. But individual investors could do the same thing. I mean, you don't have to buy anything. You can hold treasury bills and things and buy what you want. Over time, you don't have to allocate money every year. Maybe there's some years where you buy no stocks, like is kind of the case with him sometimes. So I think, the Japanese trading companies, for instance, are not that different than some other things in the book about his early investments. I think he would make the same sort of investments then and now. They haven't really changed. Um, the companies that you see at the top of that list, your Apple, your American Express, Coca-Cola, skip the oil companies. You got Moody's, Kraft. He did buy Chubb. That was almost certainly him. Um, so all those, if we do everything from that point up, are just too expensive. I mean, he probably likes some of his businesses, but they're too expensive. So there's not a lot of cases. I mean, it depends on the tax rates, but I would say there's not a huge number of cases in his history where he's paid more than probably 10 times or so what he thinks pre-tax profits are on a company, which in his early years might be 20 times, and then other times like 15 times PE. So he's probably not buying at a PE adjusted for cash and things like that more than 15 very rarely in his career. Even if you hear that he bought Coke at 18 times or 20 times or whatever, you have to look to see how much it was growing and what kind of the forward number is on that. He paid a really high price for Buffalo Evening News, but he expected to be able to save a bunch of money right away on that. See's Candies, they expected to raise prices right away. And it wasn't a huge price. It was more in line with what I just said. So the biggest one is, lower PEs than the market has. So that's obviously a problem for today, more so than anything else, I think.
Not only that, but think of all the pod shops where they don't care about valuation. They'll just short it because it's going down, or buy it because it's continuing to go up in momentum. It's just so different that way. I even think that is true about Buffett. He's probably never paid, or not often, more than 10 to 12 times pre-tax profit. I remember, actually, I think he has said that before as well, like publicly, like on how he thinks about valuation, because everyone's always trying to drill everything down to a formula. So I don't know if they asked him that at Omaha or what, but I do remember when I started learning about Buffett, I distinctly had that in like my valuation notes on how he thinks about valuation. Yeah, it was like 10 to 12 times operating income or pre-tax income. Yeah.
Yeah, he doesn't buy the cheapest possible companies of all, but he only shops in the basically the half that's lower PEs normally. There's some exceptions. Coke was not a below market PE or something when he bought it, but around market level PEs and below. So even if he buys, what's perceived to be a high quality company, something's going on with it at the time that he buys it that is not at a unusually high PE ratio. Um, and that can happen with a company where it has good past results, but for whatever reason at the moment the PE isn't very high. But no, he's never done kind of so those would be, I guess you could call them growth at a reasonable price or whatever type things. So value boarding on growth at a reasonable price, but he's never really done the Phil Fisher thing of paying up for stocks in terms of their P ratios and things like that. And then he's usually stayed in, I mean, the big thing is avoiding technology things. He has bought, as I just mentioned, he has bought things in retail and some other things that change over time, and not always done well. So he has been in some rapidly changing industries that maybe he didn't intend to be in, but he certainly avoided technology things almost exclusively um, throughout his career.
Hmm. Why do you think he sticks to certain industries like banking, insurance, consumer, all that sort of stuff? I mean, he still does. I mean, he's done energy. He has done pretty. Everyone
Mhm.
acts like he doesn't do anything that's really um like sexy, but he does go into all these different industries. I guess it's just really he's not buying like social media companies and Mag 7, which should probably be changed to Bag 7, and stuff all like that.
I don't think he cares that there is a public market for stocks, and in terms of how he evaluates whether he would buy it or not. And then I think he makes all the big difference between him and everyone else is he makes all of his decisions completely himself. Doesn't rely on other people at all. Occasionally, Berkshire has bought a stock with Buffett doing it. That was clearly someone else wanting it. Like Charlie and everything really wanted BYD for a while and him to get it. He bought a little Costco, and Charlie probably wanted to buy a lot of Costco, but that was his one concession to doing that. So, because Costco was too expensive, so I think that to me is the biggest one. If you have analysts, if you pay for research services and read a lot of things and rely on that stuff in terms of making your decisions, or you're looking at it over a shorter period of time, kind of having other aims besides just objectively trying to buy things that you think are cheap, whether they were publicly traded or not. I think those are the two differences. So complete independence of thought that he has, and the idea of treating it as if there isn't a market. Because that's why he talks about Ben Graham things all the time. Those are very much the basic philosophies of Ben Graham. Although people like to talk about things like the formulas of the nets and the different things, that's not what he stressed in his teaching so much. What he really stressed is complete independence of thought and acting, the Mr. Market type analogy there of looking at it as if there isn't a market at all, really. And he did talk about margin of safety and all of that too, but those were the really big ones. So the simple answer is like for anyone, there should be things you don't understand. And he feels he doesn't understand technology. Other people may say they don't understand banking things or energy things or political things of different countries or whatever. But there's just whole areas of businesses that if you were just buying businesses without being in markets, there's whole things you probably would never invest in. And so there's whole areas that he doesn't invest in.
Hmm. Were there any investments that stood out in the Buffett's early investments book?
Hmm. There's no investments in there that I didn't know about.
Hmm.
Um, but the most interesting one is Philadelphia and Reading.
Why is
But I
that?
knew plenty about it because it is the example for Berkshire Hathaway. And then actually, he buys later in his career, he has another experience with it when he buys Fruit of the Loom, actually. But um, Philadelphia and Reading, let's see. Um, okay, let's see. Okay, Ben Graham first bought PNR stock at $18 per share from Baltimore and Ohio Railroad. He increased his position in 1954. So that's what we're talking about. So this is near the end of Graham Newman. And then what happened from that is they decided to change what they were invested in over time and to buy into other companies, acquire them entirely, and in some cases, acquire them entirely, and leave the uh, current manager in place. So, for instance, they signed a good example is one of the first ones that they it this is basically Fruit of the Loom. It had the Fruit of the Loom license, so it was producing for it, but it wasn't actually Fruit of the Loom. Like it was the licensee. It's kind of the same story that happened with Tempur-Pedic, where the Tempur-Pedic, which is the U.S. company, eventually took over the Tempur-Pedic, which is who it was licensing from. Same thing with Union Underwear. So when they bought Union Underwear, they signed a 5-year management contract with the CEO who was already in place, and then they gave him a bonus of 10% of the operating profits.
Mhm.
And so that idea of buying these companies and leaving people in place, and that had been basically a coal company.
Sounds just like the Phil deal that we just talked about from the annual letter, the
Yeah.
way he incentivized them, yeah.
Yeah. So that's what you would do over time in terms of finding different things about capital allocation. I mean, the big thing with Buffett, I mean, this is really, really obvious because of the Berkshire Hathaway thing, but in most of his investments, they have a strong capital allocation aspect to them. So a ton of them are industries that have shrunk or consolidated. So Um, Union Street Railway in there is it's a streetcar company, but it's actually a bus company. Because that had shrunk dramatically. That was a boom industry into I don't know, maybe the 1920s or something, and then it plummeted from there. So the industry didn't really exist before the 1900 or something. Then grew for 25 years and then plunged down to almost nothing. And that's because as people got cars and everything, that got rid of them using, and to some extent buses, that got rid of people using streetcars, which you could see in an old movie or something, but now, a trolley business basically. Um, and they were a really big form of public transportation for a brief period there. Same thing here with like the coal industry, because that was a coal that was tied directly to railroads. So a lot of these we saw that with whether it was airlines when he made those investments in airlines or railroads did the capital allocation rationalize and all of that kind of thing, and would it be better going forward? But even when it's individual companies, Coke, he bought them when they stopped acquiring things and started buying back stock and doing all of that. And so that's very common for his changes into different things, is that he expects an increase in return on capital over time. So he expects it to get even better than it appears to be, which is something he's talked a lot about with the Japanese trading companies.
Mhm.
Right, it's not just that they're cheap and everything, but it's that their capital
The
allocation is now
application.
good. Yep.
Yeah, it's
Mhm.
changed. So what was weird about that though, did it already change? Like, what there wasn't really a long-term record of that capital allocation when he bought in, which is sort of unusual from how these other companies are.
It's very, very, very obvious that it changed dramatically, and it's Japan,
Like,
so it's
their
different.
attitude towards it.
Oh, they had extensive things in all their annual reports. All of them do, even the smaller ones, uh, that go on and on about it.
And even like from a regulatory perspective, if you could recall during that time, it changed as well. Like, they were almost incentivizing or encouraging, managers to think a certain way about capital allocation.
I believe all the companies he invests in have a section, I think, where they would at least say whether they trade below book value and why they think they trade below book value, and what they're doing to get above book value,
Yeah.
which is not done in the United States. So, but if every company had to do that, that was trading below book value, that might improve capital allocation, right? So,
Mhm.
so some of it is regulatory things, and then other ones are just the companies copying each other. So, that's a big thing for that. So, I mean, they have very, very extensive annual reports generally as compared to American companies. Not so much in terms of describing the business and giving you actual financial data, but more in terms of describing their corporate governance philosophy and a lot of things about their board and their management and things like that.
Mhm. So let's talk about Buffett 1.0. as it relates to banks and financials. We'll talk about banks first and then insurance. What do you think you would look for in a bank?
Well, he did buy some banks when he was both in the partnership years, which has been covered in some places, although it's not in that book because there's not a lot about it. It is covered a little bit in one of his partnership letters, and you can find those in places. And then also when he bought Illinois National, the Rockford
Mhm.
Bank.
Rockford Bank,
Uh,
yep.
so in each case, there's a few interesting things. One, they were good banks. Two, he got a special deal in the
What is,
sense.
so wait, first off, what the good bank? What does that mean? Like good efficiency ratio?
Yeah, so I mean, I'd have to check, but the Rockford Bank was probably one of the most efficient banks in the country when measured on a return on assets basis. You know, it's covered in Capital Allocation, the Jacob McDonough book. It's covered a few other places where you could find it, but that actually has year by year financials that would give you return on assets. And certainly in terms, now return on equity might have been fairly normalish in that it was in the low double digits, even though return on assets was very, very high. But that is an issue. So a bank that grows quickly but has a low return on assets and has a decent return on equity is somewhat more risky sometimes. And so something like I could pull it up. I think well, actually I don't think I can because it's no longer a public company, but I was going to say if I could find the history of First Republic, that was a bank that had only so return on assets but much faster growth.
Here's we got the history still through QuickFS. It's
Okay.
point 4 PE.
Oh, yeah. Yeah.
Too soon or what? Yeah.
So it
That was
never
a wild situation when First Republic failed. That was quick, happened quick.
So it never had a return on assets from
Not
2017
fail,
through
but was
its.
eventually purchased. But yeah, you know what I mean.
Mhm. So it never
And this was like the Compound Bros' favorite stock, by the way. First Republic.
yeah, well, I think we and many others do business with them, right?
Yes, we did. We
Yeah.
did. We don't. We did.
Yeah. So I mean, yeah, I mean, I think I don't know, but I mean, I think that helps Interactive Brokers as a stock or something too, and other things that people are familiar with as opposed to ones that they don't know anything about. But
Sure.
yeah.
Yeah, like they have the firsthand experience of being a customer. Yeah.
Mhm. So they probably on a return on assets basis or something had like the exact same kinds of numbers as Frost, which we've talked about before. Yeah, pretty much. And yet, loans to deposits for them were generally twice as high, right? So Frost was going at 45-50% and they were going at 95-100% or more, and they're growing twice as fast. So I mean, if things get better, it works out for you eventually, I guess. But what I meant is the efficiency was very high in terms of the return on the assets. Um, in their case, Illinois National, it was, like you said, an expense based thing. They're very good at controlling expenses. And then they were pretty conservative in terms of what they were what they held. And then, as is talked about in that book, and I think Buffett mentioned before in like some annual meeting or something, there was a law that was in effect in Illinois at the time, which meant that they really could only have one location in the state. So they weren't able to just merge them and to have banks across states, but not just even that, but have a bank that kind of had many different branches across the state. So it was a matter of having a lot of deposits per that one branch and being very, very frugal, and then just not making bad loans. But as long as you made, you know, I mean, because it was a bank, it made loans. But honestly, if it had just owned any sort of interest yielding thing, that that they hadn't selected badly, they just had a kind of normal experience in it compared to everybody else, they would have done great because their cost of capital was below other people's because of how cheap it was for them to gather the deposits on like an operating expense basis. And so I think the Snowball talks about that, or certainly I think Charlie Munger talks about that um, that he did not want a high touch service kind of bank and everything. He wanted to keep expenses as low as possible, have as few employees relative to customers and everything as possible, and really get costs down. And then he could, make more money while paying the same or higher for people's savings. Um, so It wasn't a super fast growing bank, actually, if you look at it, even while Berkshire owned it, and it had high, but not, impossibly high returns on equity, but it had some of the highest returns on assets in the country. And then when I said that he had bought into something in a situation with a bank and the partnership years, that's a similar thing in that there's a large owner of the bank, and the bank didn't pay dividends initially, and so he had reasons to think that the stock might be undervalued, but that if you looked at it as an entire business, it looked cheap. I mean, that's what's common to all of Buffett's things. I mean, he likes good management, good capital allocation, but he's willing to buy on any sort of valuation basis. So he likes it cheap, but he'll sometimes buy things that are earning nothing. Berkshire Hathaway was earning nothing. Um, the street railway that I mentioned was earning basically nothing. But in those cases, they're super cheap compared to assets. Like they could be liquidated probably for close to what they were selling for initially. So, yep. So there you go. That's another one. Now that was a bit of a problem because a lot of it was in inventory. So then, he had Harry Bottle get involved with that to have to turn that around, and that came close to going under for that reason because the company kept getting more and more and more inventory. But whereas in Berkshire Hathaway, he more quickly, once he was able to get control, had someone, or I should say, Dempster Mill, there's a period where he was influencing but not really controlling, and I think they hired someone that he wasn't wild about, and then they didn't enforce things as hard as he wanted. Whereas in the case of Berkshire with Ken Chase, there, I think that you can see that they quickly brought down inventory and stuff really, really fast. In the first couple of years he was at Berkshire, even though profits weren't amazing or something, revenues weren't amazing, what they did with costs were good, and then what they did with cash was even better. So they slashed some expenses, and they really slashed like working capital that they didn't need out of the business. So turn things to cash. So kind of what you can get out of a net if you have control or something. So that's the other thing. I think that's a huge difference between Buffett, like 1.0 or whatever we're talking about, and 2.0, that people don't appreciate, is that he's trying to do the same thing. He It's always been about get something cheap but good and a good manager, and then have the right capital allocation. When he was younger, the easiest way to achieve that, laws were a little bit different. He was working with less capital, and he was just willing to put up with a lot. Was to go activist on these things, take control of them, and then to do it himself. And that's the most effective way because then he controls it and everything. And that's the cheapest because we've talked about that before with other companies. People ask, why does this company trade this or whatever? And you say, well, there's someone incompetent there and they control enough to block smart things being done. That's the most common reason why, like, a micro cap that is actually pretty good business consistently trades at not a good price today, would be there's something in place that stops someone from being an activist in it, and the capitalization isn't that great. Just stopping someone from being an activist is not a problem. I mean, if they're doing a good job, then it doesn't add anything to the value of the stock that people think there will be activism in it. It's only in cases where there's no chance for activism and the people running it are, the cap allocation is poor and things like that. So he always had the same sort of strategy that way, but then he became middle aged and decided, I never want to do a Dempster Mill again. I never want to be hated by the whole town.
Mhm.
And
He didn't wanna have to
um,
pull out, his wallet and look at pictures of his kids, during the
yeah,
board meeting because he was so
that,
angry.
yeah, that was Sanborn Matt. Yep.
Yeah. What were they, smoking cigars?
Hmm. They owned almost no stock in that one, and he was hoping for them to basically do a big buyback or to distribute the cash that they were sitting on, basically the investments that they were. So that's a pretty famous one, Sanborn Map, Dempster Mill. Those are not in the Buffett's early investments. Um, so I think that's more of the big change than people realize. I think it's a change in terms of personality, and I think it's for durability because he did quit the business. So it's just like he's not going to keep doing this forever. So to be able to stay investing for all that time, he changed. He's never said that that was kind of optimal in terms of getting the best returns, but it was optimizing for longevity because no one else stays in that long. You can have the approach of, well, take like Phil Fisher versus Peter Lynch. The Peter Lynch approach of owning a million stocks and meeting with every management and doing everything you can and being aware of everything and putting in all the hours and doing all that. Great, but he didn't last that much longer than a decade doing that. And then it was like, I have to stop. If you have a portfolio of half a dozen stocks or something more along the Phil Fisher approach and know each one really deeply, then maybe you could do that for decades and decades. And with Buffett, if you just give up on things that are hostile investments and things like that, then you can last longer that way. So I think that I actually think that what he's aiming for has stayed remarkably the same. Um, it's just what he's been willing to do to achieve that has changed, and then the size,
The opportunity set.
yeah, and that's changed mostly because of size, but also I think somewhat because of changes in investing, mainly private equity for him. It's become a
Mhm.
major competitor.
So we hit on, I mean, capital allocation, the way he thinks
Mhm.
about that. What about growth? How do you think he thinks about growth?
Doesn't care. Yeah, that's his big advantage because of the focus on the cap allocation. Because growth is, I don't want to say growth is never undervalued in the market. There's probably times where it is, but
But I mean, what is growth? Like, define it. I mean, if it's growing at GDP, do you consider that growth?
yeah, yeah. But I mean, some of the
Okay.
but he doesn't care if it shrinks. I mean, that's the point about if you take over a company, if you have that kind of,
But then it
I
becomes
mean,
much more of a capital allocation story. I mean, it always is, but if it's shrinking, you need to be pulling things and moving things, reinvesting things, right? Returning it to shareholders, doing stuff that's different.
yeah. Otherwise, the profitability will decline. If you just focus on the return on capital and everything, if you put more capital into a business and it doesn't grow, then the profitability will decline. And on the other side, if you don't add capital and yet profits go up, then your profitability increases and profitability ratios. We just went over the other week when we talked about the letter, what he kind of talked about. I was saying almost as if they're permanent holdings. They all have really high returns on equity and really high returns on capital. Um, I mean, I looked at lots of things about does growth as a strategy work, and eh, probably not. I mean, the issue is here. Growth has two aspects to it. One is asset growth, which is pretty negatively associated with returns, and then profitability, which is pretty positively associated. So obviously, if you have a good business, you want it to grow. If you have a bad business, you want it to shrink. And so growth as a strategy is a little difficult that way. I think everything that's growth captures normally in terms of people's returns and investors who say they're growth investors are really profitability investors. Now, they might be profitability quality investors in terms of future quality. That is, it's not showing up in terms of profits today, but the customer economics are so good that I know that it will later. But you're betting on it being a high quality business. There's no such thing as like growth in, I love businesses that grow really fast but aren't great businesses. We just talked about First Republic. That was a very average for a bank business that was growing faster than most banks, right? So it had the same profitability as Frost, and yet it had higher, it was pushing the capital harder,
Yeah.
but also it was growing twice as fast as Frost or something at that time.
Yeah, we
Yeah.
could compare the two. So 10-year
Okay.
CAGR, earning assets, 20%, return on equity, 10.3. Could look at Frost. Yeah, I mean, look at the difference there. 10-year CAGR, earning assets, 6.4. Their return on equity was better, 12%.
Yeah. So if we look at what have we talked about before? Let's see. I mean, look, if you look at a company like um over the counter markets, right? Or Copart, or I don't know. There's a lot of other ones. You know, um,
It's like a Copart. It's been a while.
yeah. So Copart's a little bit harder because there's a physical aspect to it and everything, but it's not a big part of it, so it doesn't matter. Um, Growth there is really good. But growth there is really good to a large extent because return on capital is really high. So one, return on equity is very high, which is the thing that really matters. To the owners, what matters is the return on equity, nothing else. So if a bank or insurance company or whatever is in theory super leveraged but has a really high return on equity, that's okay. If a real estate company is, that's okay. You would just have to know that you could continue to achieve that. And you kind of have to know the industry and all that to know if that's going to be the case. But what matters, and Buffett's always said that. He said he likes businesses that earn a high return on equity without unusual leverage or, undue leverage, he said at times. So that's the number that really matters. And if that number is high, then growth is good. Um, if the average return in the stock market is, let's say, 10% a year historically or something, then as long as you have a return on equity that's sustainable, um, that is, say, 11% or higher, then growing is good. But otherwise, growing isn't necessarily good. And companies often, not always, but sometimes companies shrink and then grow. And sometimes companies pivot from doing one thing to doing another. And a lot of times that's where they become affordable. And so many of the cases that is in the early investments and that you can just see from what Buffett has done is cases where there's some sort of change around the business that has to do with that. Um, where there's a fear that growth will slow down, but he doesn't think profitability will slow down. They'll start paying out or something like that instead, or they'll start doing other things. Um, or there's a lot of fear about growth, but it proves that that isn't the difference between a how do I put this? So as an example, he had two investments in there that in the Buffett's early investments book, and in that one is a cooperage, which is it makes containers for shipping. Basically, what those containers were changed over time. So it's a barrel maker originally, and then there's different kinds of barrels, but it went into different things from there because that's what it is for. And there's fear about growth in that case. And then something like Hot Cone, which was a department store in Baltimore, there's concerns about growth there too. Um, the difference is that one of those, which he bought in a big way, the department store, did not do well, and it's because of competition, and that's a profitability issue. So a couple of things happened. One, big cities declined versus suburbs. Two, the company had three other competitors right in the middle of Baltimore there, and then also Baltimore as a city declined in importance and desirability for people to come into the city to shop and do other things. So, um, that was just a competitive issue, and that is more important to him than other things. I mean, when he sells something, it's often he doesn't like the capital allocation risk profile, whatever, of that he sees management doing, or he sees a change in the competitive situation. I don't see a lot of situations where he just sees a change in like growth as being his reasoning for doing that.
Mhm. Did you see, reports this week that he's selling their real
Yeah.
estate business to Compass? What's that all
Hmm.
about? I mean, because we were just actually talking last week how he doesn't really sell anything. He just will
Never
just kinda
sells.
just won't put more capital into it and just kinda let it run off or whatever, right? So I thought
Hmm.
that was kinda weird, right? Unusual that way.
Yeah, it would be one of the first cases where he sold something, an entire business. Uh, I haven't seen confirmation that they're doing that. I also don't know what the relationship is there and with the energy company and everything, where that's housed and all that. But because part of the real estate business was originally part of a larger business, but they actually bought something else after that. So I'm not sure. Some things have changed in the brokerage business over time, but that was actually a couple years ago. So, or yeah, a couple years ago. I don't know how many of the decisions that are being made now are made by him and how many are made by others, right? So we might see more of that, but that is very unusual to sell an entire company if that's really what he's doing. Although I guess it would just be combining it with another very large company. But that's also, like I said, I mean, think I saw the same article as you have, but that's, was several days ago and not confirmed in different things. So but yeah, he hasn't done that, and that obviously has hurt Berkshire's returns over time. You don't have any ability to exit things. So that's another thing with the like 1.0 versus 2.0 we were talking about is that I think we did talk about this with the letter, but I noticed that he went on and on much more about how buying entire businesses gives you some advantages, but some disadvantages versus owning a stock, and so that was interesting. That you don't have to own things forever. That sometimes that's a mistake.
Yeah, yeah. He did highlight that.
Yeah, and I think one reason is psychological, which you kind of laid out, which is it's very easy to deal with a management change because with the stock, he just sells the stock when he doesn't like the management. But it's hard for him to make a management change when he owns the company. Now, other owners of businesses think that that's one of the advantages. They get to change the management, but he's very reluctant to do that.
Mhm. Do you think that'll change when Greg is CEO from, like, an operator standpoint? Be much more willing to cut bait, or do you think that culture will continue?
Um, yeah, I think he probably will. And I think people they'll be more likely to quit and everything too and leave and go to other places too. Um, I, I don't know how much of an advantage it is after the first person that you bought from leaves. I think it's an advantage. I mean, he's often buying from a founder, not always, but often. And until recently with really big companies, that was pretty common. I don't know that there's huge advantages to like having a second generation person or whoever was picked as the successor stay in place. And that has happened with Berkshire because he's owned some things for so long, Buffett, that they've gone through a few. Um, I mean, we know he has changed management a few times in some things, but it doesn't seem like it's very common.
Mhm, mhm. How do you think about how do you think he thinks about, like, the competitive position then, right? That's the thing he's most worried about in companies is probably competition.
Yeah.
So when we talk about, like, shrinking industries or industries that are in decline, well, if an industry is in decline, there's probably not a lot of competition, right? It's not like NVIDIA or, AI where there's every company in the world competing for that market share, and it's like a land grab and spend as much capital as possible, right?
hmm
So how do you think he thinks about that?
I think that's the biggest reason why he doesn't own technology things. He said that before where people say, like, "You don't understand it." What do you mean? You don't understand if people consume it? You don't understand if, how it works? And no, he means he doesn't understand the future economics of it. I mean, that talk that Alice Schroeder did about, the tab card company was a really good one for understanding that in terms of when he did not invest and then later when he would invest in it.
Do you wanna lay that out? Refresh that in people's brains?
Yeah, so there's some complexity with this, but there are some things with IBM where basically the company's making punch cards basically, which are like they were consumable that went into computers. Computers here are making calculations of things that aren't things of personal computers and stuff like that. And so they're literally making calculations, but they use this and they need it in high volume produced. And then also there's a issue of the location, how quickly you can get to them and everything. So he was worried at first that they'd be put out of business by IBM. Figure that they put them out of business right away. And then within a year or so, it literally was only just about a year of seeing their financials, he realized how high their returns on capital were and how willing people were to buy from them instead of from IBM. And so then he was willing to put in money, and it actually turned out to be an incredible investment over time. Very small investment though, but a huge part of that was the turnover in terms of how high sales were versus the capital in it, because they basically just needed like a card press. I don't remember what the equipment's called, but um, which and then you had a tiny amount of inventory probably, um, and just putting these things out and sending them out to their clients. So and you had a huge installed base that they had nothing to do with, right? So um, and so he was willing to invest in that. And I think Apple's the same sort of situation. Probably looked at Apple a lot, and then you can see at what point did he decide to invest in Apple, where he decided I'm not worried about the technology stuff. I'm willing to invest in it now. And it's not crazy because when let's see, okay,
He's
so
actually
okay,
ironically one of the best tech investors ever.
well, in terms of how much dollars he made,
Yeah, on a dollar for dollar basis for sure.
okay. So he first bought his stake in Apple. The AI here tells me in the first quarter of 2016. Maybe that's true. Maybe it's not.
Is that Gemini? Did
Um,
you Google it?
I just did it through a browser. That's none of those things that anyone's heard of. I don't know who they're using. So that is 9 years, a little less than 9 years from when the iPhone was first released, right? Because the iPhone would have been like 2007 or something. So, and it wasn't. I mean, I'm sure they sold a lot, but it wasn't obvious that it had huge market share until a couple years later. We could find like BlackBerry's market share and whatever things of other whatever passed for a smartphone at the time plunging and them going up. That probably took 2-3 years. So it had complete dominance for I don't know 7 years or something when he bought in. And in tech things, that seems like, oh, that's slow. Whereas with Coke, you could buy in, be an early investor in it decades and decades into it. But I don't know. At what point did you know? I mean, a few things had to happen. One, we know Steve Jobs talked to him. So Steve Jobs had to die because of the capital allocation, right?
Yeah,
And
that's
then he
right.
had to be sure that Apple was really um uh dominant in terms of the iPhone, basically.
Yeah, because
So how
Steve
could he
talks about
know?
what he should do with all the cash.
Yep. Yeah. So those are kind of the two things. And then the price had to be kind of okay. And the price was, I believe, we could look this up in well, it only goes back to 2016 now. I was gonna say you could look. I mean, there you can look back further on QuickFS, but actually, it had been. There was a couple years where it was quite reasonably priced on a PE. It was coming down and pretty good price for a few years there. You had like a 3 year or so period at least of having a below market PE in Apple, even though it was still growing and everything at the time. Although it was going to slow down a lot, I guess. Yeah. He bought actually at a time when it really slowed down, right? It actually that was like a
Mhm.
terrible year for them. Yeah.
Yeah.
So,
Mhm.
yeah. Um but in terms of we can see things like margin that stayed stable, but things like return on capital actually got better while he owned it probably.
Yeah,
Yep.
it did. Mhm.
So he bought actually at pretty much the bottoming out of the return on capital, maybe 1 year ahead of it bottoming out. Yeah. So great timing, right? So he timed it to have one of the lowest possible PEs that the stock would have and to have one of the lowest possible returns on capital at the time, too.
I mean, was that something
So,
that just happened, or is that something that you think he thinks or he thought would happen, like with return on capital improving?
um, yeah, well, what's interesting is so Apple's a really, really good example of something that Buffett would buy. I think what's really attracted to him is Apple almost never makes meaningful acquisitions. Um, it's like a cultural thing. We'll see if they ever change that up. But because of that, he could have a lot more faith that as they piled up a lot of cash and everything, they were going to um, have to do what he wanted, basically, in terms of what the returns would come from. So if we look, they've bought since he got involved. Shares outstanding have declined, what, 5% a year, 7%, 3%. 3% is the lowest, 7% is the highest. And then they've also paid a dividend. But more importantly than that, like the stock, uh, the number of shares outstanding going down, yeah, that's important, but we shouldn't just look at a corporate basis. The other thing is they've really, really not expanded that much beyond the iPhone franchise. Like they make a lot more from services and all that, but it's all connected to his exposure to profits from that same ecosystem of that Apple name there is just gotten bigger and bigger every single year. And that's where most of the money has gone. And then some has gone to pay dividends. Right. But otherwise, whereas he was in some other businesses where even if they bought back stock, that wasn't always true because they expanded into other things. And sometimes they diluted to buy other things. And that was a big problem when he was in some consumer products ones. Berkshire ended up with Duracell and different things happened with Gillette, but and then Gillette merged with P&G. But I don't think he wanted Gillette to own Duracell. Probably, I don't think he wanted what was it? What did Coke buy? There would have been a few different ones. I guess there was a let's see. Was it was it Gatorade acquisition? Probably he was a Coke shareholder when that happened. Probably. So they just get away from the main brand that way. As much as he likes Coke, Coke has expanded to all sorts of different things related to their core brand as their core brands decline that way. Instead of just buying back all their stock and everything the way that Apple has. So, his, I mean, we can look on what his, I mean, it's really easy to look. If we go to Dataroma and look at his biggest investments, the thing that stands out to me is These are not necessarily the biggest companies in the world that he owns stock in. He would have to own because they're really big. But these are some of the biggest brands in the world. Apple is not just a big company of big tech companies. It is most dependent on a single brand. American Express is very dependent on a single brand. Coca-Cola, Moody's, it's one business basically, Kraft Heinz is a couple businesses. But those are really where we end the Buffett investments probably. I mean, he owns some things down below, but that's because he's either selling them or he didn't get as much as he wanted or whatever. But when we look at the things that are $10 billion and up, they're also really, really they're high return businesses that are really dependent on one thing and not widely diversified usually. So he can understand the competitive situation and like what their returns will be if they return either to him or they invest more in that dominant brand. Um, that's why the capital allocation thing is so important in the different stories that are told in books like that one, the early investments book, because you can see when he gets involved in what direction they're headed in from then. And that's true with all. I mean, American Express was going through change. He invested in a few different times, but if we go back 30 some years when he invested most of what you see in that stock now, they were going through changes in a direction he liked, getting rid of other things, focusing in on the American Express brand. Coke was doing kind of similar things in terms of taking, buying back stock and not diversifying. Um, Moody's was a spinoff. Actually, he got it as a spinoff because it was originally part of Dun and Bradstreet. So,
Yeah, it's more of like a pure play, which is much easier from like
Mhm.
when you're underwriting or thinking about it, the competitive position, what the business could look like. It's much easier to understand if it is a pure play that way.
Yeah, and I think that's one reason. I mean, they said, Charlie and Warren had both said that they should have invested in Google, that they knew about its advertising strength from buying things for Geico. But I think that's a big reason why they didn't invest in Google slash Alphabet, and probably a big reason they didn't invest in Amazon. Um, Amazon's also a retail thing, but that they, did so many other things, and it's hard to evaluate whether those things will be successful or not. So he likes very singly focused businesses, where he can understand the math and everything pretty simply. I mean, he puts a very high priority on being able to do everything in his head without it writing anything down and having a high degree of confidence in it, I would say, in terms of when we compare him to other investors. So that means forming opinions about things like Apple and American Express and stuff, and not, you know, Nvidia or not some of the others. Even when you ask about things like oil companies, he just talks about the price of oil and the capital allocation. Like, so if he thinks the price of oil is going up over time and he likes their capital allocation and then they're cheap compared to like what they own, he doesn't talk a lot about, getting into complex analysis of them.
Mm-hmm. We've
Um,
always talked about that. I was like,
yeah.
do you think he goes into a complex analysis like that? Do you think it's different where he's not writing a blog or a Substack or putting on investor presentations,
Mhm. Yeah, I think that's kind of a big advantage that he has. If you're inactive enough. If you're pretty active, I think it can help to blog or to write things up or whatever. But in general, I think that, you know, when I've written things up, I try to do it a little differently that way. But it's not good to try to kind of pitch your investment, um, for a few reasons. One of the biggest one is you spend an incredible amount of time on things that don't really matter that much to show, oh yes, I know about that and everything. Oh yes, I know about the carbon capture at the whatever place. Is that really going to matter? you know, eh, he probably puts an expectancy, on it. That's how I think he does kind of value expectancy on all sorts of things. And it's like, well, could this work out? Yes. What's the chance that doesn't work out? What's the chance that, it actually like loses money? Some of these things, that's part of it. When anyone does a write up, they always say, it's a lottery ticket. They say, well, let's just put it at zero and it's a lottery ticket for whatever. But a lot of times it doesn't work out that way. Like if you own 6 different money losing internet things on the side, it's true that one of them could take off and that'll be great. But in many cases, you pump in additional money into them to lose a bit over time, and so it's even worse than that. On projects that are more like, engineering type things or things like I mentioned, carbon capture or something, people always say, "Oh, it's a, like, let's put a value of 0 to whatever on it." But the first time that someone does something with the technology, they often lose an incredible amount of money. So, like, the first company to try to put in this new boiler to do this thing at this plant, I mean, it probably will not be good. But they'll figure out how to make it, successful in further technologies. Um, I mean, I guess my point with that is just like, I think he does an analysis that way, but it's very easy to be like, oh, he should have seen Apple early or something. But he has to see Apple, but not falsely see BlackBerry or something like that. And that may be harder than people think without hindsight on it. Like, yes, at some point you can see that with Apple, but when is that point? Is it really immediately or is it a few years down the road?
I mean, go back to BlackBerry and how hard that would have been, honestly. It's like this thing that they have massive market share. It's enterprise, right? So corporate, they have their own niche that way. And then the iPhone comes out. And even at that point, I mean, I remember when the iPhone came out, everyone's like, what? Who would want a touch screen? What's the point of all of that? Blah, blah, blah. People were still against it. And then just plummet, completely plummet. Basically, like what? Within a year. Read that book, Losing the Signal or whatever. Yeah.
Yeah. Yeah. And if that's the kind of thing with the magic formula, when people ask this magic formula work or something, I mean, the magic formula is like Buffett without judgment that way, though. So it catches both Apple and BlackBerry. And, I mean, Buffett talked about in the letter, though, your winners do more than make up for that if you're willing to hold. So if you get into good businesses, at least, if you get into ultra cheap businesses, like incredibly below liquidation businesses, or really great businesses, if some of those are in the mix and then you hold on to everything, you can afford to have some losses and other things because you get many times your return in the things that you keep, as long as you keep them long enough. You're not like saying, I'm going to sell everything when it goes up 20%. Um, but yeah, that's true. The median return in, like, we've talked about net nets or something. The median return in net nets is like a market type return or something. But the return is higher because if as long as people will hold some of them for a little while, they're so cheap they go up so much. It's the exact same idea with great businesses. Um, if you just bought a sampling of everything out there and held it forever, then obviously that's not going to work the same way. But as long as he buys things like Apple and Coke and all of those, and then things that are much smaller, so you have a See's Candy that pays for a lot of things. And then at Berkshire they starve the other things for capital, which is the other part of it. So you don't recycle it. So that's kind of a really big thing there. He's very good at that. He's does not sell his winners and then buy more of the losers.
Yeah, that's true. He definitely does not. Yeah.
No, and he does it in the businesses he owns just because that's easy to do. The winners will grow, and then the losers they just don't let grow because they're not earning enough return on capital and everything. And then in his own portfolio, he does that mainly by long term holding things, and so not just selling something because he gets bored and wants to buy something cheaper or whatever. So he's selling a winner to buy a loser. But in both parts, he's very good at that as compared to most investors. Yeah. So I mean, I think yeah, he would buy smaller companies. People always ask that and think, "Oh, is that really not true or whatever?" But he's always said that and said the things about how you can earn high returns and things. Um, I mean, the other thing is he does follow the, you know, um, book I would recommend is A Man for All Markets. He follows the Ed Thorpe kind of approach of he only invests in things where he has an edge. And so that's true of the early Buffett, that's true of later, where he just doesn't do anything where he goes, "Oh, well, I'll do this to diversify, or I'll do this to have that." He doesn't look at it at a portfolio thing at all that way. He's not buying oil for any other reason than he thinks oil companies he expects them to do better than your average business for each individual investment that he makes. And then by doing that, he kind of thinks it will work out. Whereas most other people are trying to do something else. So, yeah, so Man for All Markets, Fortune's Formula, other things about the Kelly formula, Kelly criterion. one of the key takeaways for investors, I think, is not so much. I mean, bet sizing is important. Buffett buys bets big when he has an advantage, but the other key thing is to really, um, the difference between that and a lot of finance theory stuff is do not invest in anything where you don't have an edge. So, the bet itself is on an expected value basis, not more attractive than other things that you could do. Let's put it that way. So, and a lot of investing is doing things where that's not the case. I mean, it's, saying, okay, I'll be underweight certain stocks that are in my benchmark or something. Okay. But part, you're now making a small bet, but part of your bet is a small bet that has nothing to do with edge. It has nothing to do with what you expect the value to be or something. It's just setting aside part of your portfolio to do that. So people are doing that to diversify. They're doing that for all sorts of other things. And it's kind of like buying insurance on different things or tamping down on it's using money, capital that they have access to not put it to its best use. Whereas Buffett's always directing it to where do I have the highest, mathematically, where do I want to put it and not thinking about anything else. I don't think he's ever thought about like diversification, for instance, in terms of like diversification in terms of I need to own a few things because of risk, yes, but not diversification in terms of I should own some oil or I should own some Japanese things or something.
Not like taking a barbell approach. Yeah.
No.
Hmm.
So I mean, and he's in the insurance business, and that's natural way of thinking about that. I mean, he said that in things like annual meetings, straight flat out, where he said, "Look, we'll make any bet where we think that were we to get 100 chances to do the same thing, on average, we would make money on it, and we'll reject anything where that's the case too." So I think there's, I forget what one is from, but there was some annual meeting where he literally says something like, "Look, if you give us a coin that pays 7 to 5, we might bet a couple percent of Berkshire's net worth on that, you know, because we have an advantage and it's not a risk to, you're not risking the company and whenever you're doing that. But most people wouldn't say, oh, I can bet hundreds of millions of dollars or $1 billion something on a coin flip where I have a slight edge, you know, but you don't get that very much is his point. Like it's not very often that you have a fair coin flip with that happening. So I just think the main things that he has, the problem that I have with most things is it's not very mathematical. We did talk about one, which is like, well, we talked about high return on capital, but the other one we talked about was like let's call it EV to EBIT or P or whatever. He does pay a low price versus earnings. But the other stuff I just think is higher return on capital over time is what he expects. Um, and then the problem is how to apply it today. I don't know because he's not buying anything today. And I think there's other factors for that with his age and stuff. But I think the market's a big factor with that.
Got it. Cool. Well, I want to thank everybody so much for tuning in with the both of us on the Focus Compounding Podcast. If you're going to be in Omaha for the Berkshire meeting, reach out to me, Andrew at focusedcompounding.com. Make sure you hit the subscribe button wherever you're watching or listening to us here today. You'll be notified whenever we upload a podcast. 8 years strong, Geoff. Crazy. Um, crazy. And of course, if you're interested in learning about our money management services, you can reach out to me at Andrew at FocusCompound.com. I want to thank everybody so much for all the support, and we will see you in the next podcast. Take care.